Welcome. Today we're diving straight into Black Monday, October 19th, 1987.
That's right. The day the Dow absolutely cratered, dropped over 22%.
Yeah, huge. Our goal here is to really understand that moment, pull out the key insights for you without getting, totally bogged down in the weeds.
Exactly. Think of it as the essential guide to a day that fundamentally shifted how people thought about market risk.
We'll look at the buildup, the role of those early trading computers, what happened right after, and crucially, what lessons still resonate today.
It's fascinating how different pieces sort of align to create such a perfect storm.
Okay, so let's unpack that.
Yeah.
What was happening economically? What made the market so, vulnerable then?
Well, context is key, right? The mid-'80s, that was a massive bull run. By '87, there was this growing sense maybe things were a bit overheated. Stock prices seemed kind of detached from actual company values to some people.
Okay, so a potential bubble feeling.
Yeah, and add to that worries about the U.S. dollar weakening, interest rates ticking up, trade deficits.
So a mix of anxieties bubbling under the surface.
Exactly. It wasn't just one thing, but this collection of economic concerns created a sort of underlying nervousness, fragility, maybe.
And then the selling starts and panic takes over. How did that part escalate things so dramatically?
Well, once significant selling began, it triggered more selling. It's that classic
It could break
cascade.
calls.
Exactly. People getting margin calls, being forced to sell to cover their positions. That just pours fuel on the fire.
Right.
And fear just grips the market. Logic kind of goes out the window. It becomes a rush for the exits, regardless of the actual value of what's being sold.
Okay, this is where it gets really interesting for me, the technology angle, the computerized trading. How did that play into the speed and sheer scale of the drop?
Yeah, this is critical. Program trading, basically automated strategies, was relatively new then. And ironically, systems designed for efficiency actually made the crash worse.
How so?
Many programs were set up with automatic sell triggers. Price hits X, sell. Price drops further, sell more. So when the initial decline happened, you had multiple computer systems, all hitting their sell points almost simultaneously. It created this immense rapid wave of selling pressure that overwhelmed the market makers.
So the tech meant to help just amplified the panic down spiral. Unprecedented, really.
Absolutely.
After that massive drop, what was the immediate feeling? What were the shockwaves like?
Pure shock. And fear. Real fear about the stability of the entire financial system, actually. Would banks fail? Would exchanges hold up?
And it wasn't just Wall Street, right? It went global.
Oh, definitely. Markets around the world saw huge drops, too. It really underscored how linked everything was, even back then. Makes you think about systemic risk, you know?
It does, just imagining the uncertainty. The market did recover eventually. Can you touch on that?
Yes, it did. And actually, considering the scale of the crash, the recovery was relatively swift. Within about 2 years, the Dow was back to its pre-crash levels.
That's quite remarkable.
It speaks to the underlying economic strength at the time, perhaps, and also the response from the Federal Reserve and other central banks to provide liquidity.
Okay, so bringing it forward, what does this all mean for you listening today? What are the big, enduring lessons from Black Monday?
Well, I think the biggest one is just a stark reminder. Markets can experience incredibly rapid, severe corrections. Even seemingly strong bull markets aren't immune.
Right. Complacency is dangerous.
Exactly. And it showed the power of market psychology, how quickly fear can override rational analysis. It also highlighted the potential double-edged sword of trading technology.
How it can accelerate things in unexpected ways.
Precisely. And perhaps it raises a question for today. How do we ensure our modern, even more complex financial systems and our own investment approaches are resilient to these kinds of shocks? Think about how panic spreads now, maybe through social media. It echoes '87, just different channels.
That's a really important point. History doesn't repeat exactly, but the human element, the psychology that persists.
Yeah.
So, wrapping up our deep dive. Black Monday was this perfect storm of economic concerns, investor panic, amplified massively by new tech-like program trading, a historic crash.
But also a story of eventual recovery.
Right. And the lessons about market psychology, tech's impact, and the potential for sudden downturns, those are absolutely still relevant for you today.
Definitely. And maybe a final thought to leave you with. Consider how those core human emotions, fear and greed, still drive so much market behavior, even as the tools and the specific triggers evolve over time.
That's something they really mull over. And hey, for anyone keen on more market history, our sources also mention tulip mania. Another fascinating bubble. Perhaps a deep dive for another day.
Could be interesting.
Thanks for joining us on the Deep Dive.